Hello, everyone. Welcome. Thank you for joining us today. It is my pleasure to welcome you to the third installment of our Building Confidence educational series. My name is Sarah Horn, and I have the privilege of serving as an associate financial advisor here at Saltmarsh and moderating this event. Before we start, I'd like to share a few housekeeping items. First, participants are muted to limit disruption, and this webinar is being recorded. A link to the recording will be sent in about 48 hours. Please feel free to revisit the recording of this presentation at any time and share the recording with your friends and loved ones. You're also welcome to share questions with us by using the questions feature in your control panel, and a member of our team will follow up with you after the webinar with a response. At the end of the webinar, you'll be prompted to complete a very short survey, so please take a moment and share your feedback with us. Finally, unfortunately, Venezuela Carr could not be with us today due to a family emergency, but she has graciously allowed us to share her valuable insights on her behalf. So I'll be wearing two hats today. I'll be acting as a moderator as well as sharing Venezuela's points. Today we have an excellent panel prepared to discuss our topic, navigating divorce, planning to protect your assets. Today's panelists represent an impressive and knowledgeable team of experts to help as you chart a course through this new phase. Whether you're at the beginning phases of separation or your divorce has been finalized for some time, the panelists today will share insights about how to protect your assets throughout your season. Divorce includes a large number of details and each situation is unique. Our goal for today is not to provide a comprehensive discussion, but instead to share points of consideration both as you begin the process and as you move forward. We encourage you not to be overwhelmed by the details, but instead to be encouraged that there are a number of professionals who are trained to help you navigate both the nitty gritty and to take the emotion out of your decisions. So let's move on to our introductions of our panel experts. Beth Scarda is a shareholder in the tax and accounting services practice at Saltmarsh Cleveland and Gund. She joined the firm in 2006 and has over 25 years of accounting experience. Beth specializes in providing tax compliance, planning, and consulting services for the firm's individual, partnership, and corporate clients. Amy G. Piedmont is an estate planning attorney with Litvak, Beasley, Wilson, and Ball, LLP. Amy's practice focuses on all aspects of estate planning, including wills, durable powers of attorney, revocable living trusts, GST trusts, special need trust, elder law, and Medicaid planning. Amy also offers expertise in business formation, business transactions, real estate, and contracts. Venezuela Carr, also known as V, is the CEO of VCAR Group, a consulting firm providing solutions and training in technology, cybersecurity, and business, among other areas. V also hosts the television show Down to Business with V, where she shares best practices for the public about safeguarding themselves from cybersecurity threats. And finally, Christina Doss is a shareholder and managing director of the investment advisory services practice of Saltmarsh Cleveland and Gund. She has over 30 years of experience in client wealth management and financial planning services and has served on a number of boards and committees in the Pensacola area. Christina has been recognized with many awards, including the Junior League of Pensacola's Women in Business Award for 2023. Thank you all for being here today. So I'd like to start with a question for Christina. Christina, from a financial planning perspective, what are the first actions an individual should take if they are considering or working through a divorce?
Thanks, Sarah. Appreciate your introduction and just looking forward to sharing some valuable insight with our audience today. So, as you know, it's quite common for one person in the marriage to take on a greater role in managing the financial affairs, while the other takes point on raising the children and caring for the home, which can result in one spouse simply not having as much insight regarding asset accumulation during a marriage. And in particular, women frequently express remorse and not taking a more active role in the family finances. And they don't always feel equipped to navigate divorce, let alone planning for their retirement as a single individual. But what we say is don't panic and don't dwell on the past, but let it guide you for the future. So, taking care of you and those who depend upon you financially is a big responsibility. And as Sarah has said, you really got to find a team that you can trust who has your best interest at heart. You don't need to do this alone. So, where do you start in navigating a divorce and ensuring you receive your fair share of the marital assets? you really have to start with kind of organizing your financial life and the paperwork. You've got to take an inventory of all assets and liabilities and retain copies of important papers, statements, bank investment, retirement accounts, pensions, tax returns, real estate held in joint and individual name, insurance documents, business assets and valuations, vehicles and titles, mortgages, and other debt obligations. It seems overwhelming, but you got to get your arms around that information, and it will serve you well to do so. And while a checklist or inventory is valuable as a starting point for the process of dividing assets, it's really important to understand that not all assets are equal when it comes to a current or future value. And this is a really important point for everybody in our audience. As an example, $1,000 held in cash in a bank account versus $1,000 invested in a stock in a taxable brokerage account versus in a tax deferred retirement account, they do not each have the same tax implication or potential for growth. And unless a vehicle or a boat are classified as a collectible, they are simply depreciating assets, while equities or stocks are generally appreciating assets. So, ladies, let the men have their toys, you take the stock. A divorce attorney's goal is to ensure you receive your share of the assets. A financial planner and CPA can help you understand which assets will have the most value to you in the long run. One other point I want to make here is that the division of IRAs and retirement plan assets do require special mention and extra consideration. So if you and your spouse are under age 59 and a half and you sell out of an IRA or an employer provided retirement account in order to split those assets, there's going to be income tax due as well as an early withdrawal penalty. Instead, you really need to go through the proper legal channels to have the assets divided via a transfer incident to divorce or a qualified domestic relations order, or QDRO, which will avoid costly mistakes. So don't attempt to do this alone. And as an example, I'll share with y'all that last year we actually had a client who was going through a divorce, and he simply wanted to get it resolved ASAP. He was literally on his way to the bank, and without consulting an attorney, he contacted us to sell his IRA investments in order to give half to his wife as part of their divorce. And if we had simply taken those instructions without asking any questions, both he and his spouse would have been negatively impacted by a huge tax bill. Instead, we came up with an alternative solution, which was a win-win for both he and his ex-wife. So again, Sarah, divorce can be a long process, and we want to make sure that kind of you get your arms around everything, and that includes updating your beneficiaries on retirement accounts and insurance policies, including group policies through your workplace, so you don't inadvertently leave assets to the ex-spouse with whom you just separated. And sadly, we actually have a current case where this has happened. Amy is going to speak more about the importance of updating your estate planning to address the needs and care of a minor child or children, but it's important to note that minors cannot inherit or manage money, so closing the loop on guardianships is really essential. And then similarly, it can be common for one spouse to retain the marriage home and refinance the mortgage in sole name. Knowing your cost basis in the home and understanding capital gain exclusion rules can have a significant impact on your decision making with respect to selling the home before the divorce or fighting to keep the home as an asset in the divorce. So Beth has some additional insights on this and other tax considerations as you navigate divorce. Beth, I'm going to turn it over to you.
Great. Thank you, Christina. Yes, she is correct. In selling the home, if the intention is to sell the home and the couple's lived in their personal residence for at least 2 out of the last 5 years, there is a capital gain exclusion. Now, if the couples are married filing jointly, this exclusion is $500,000. So, example, if you sold the home for a $500,000 gain, there's going to be no tax consequences if you're jointly. Whereas in the division of assets, the home was given to one spouse and then they sold it as an individual, this exemption would only be $250,000. So in that above scenario, this single spouse that sold is going to have to report a $250,000 gain, which could result in about up to $60,000 in taxes. So this is an area that you might want to work with your spouse before to reduce the tax consequences in that area. So if for tax purposes, when it relates to going through a divorce, my first recommendation, as Christina's was, is to get your own CPA. While your situation might be amicable, you still want a CPA who's going to solely represent you and your best interests. So, relating to the first steps, unfortunately, not all divorces are going to be settled in one calendar tax year. So the IRS considers you married for filing purposes until you get a final degree of divorce. During this stage, coming to the end of tax year, you have two options: married filing jointly or married filing separately. Now, I've seen about 95% of the time married filing jointly is going to be more tax beneficial. So the ideal scenario is for both CPAs to be working together to determine the filing status that is going to generate the most tax savings. And as I mentioned, this is normally married filing jointly. So if this is the case, I would highly recommend coming to an agreement of the allocation method of either the tax liability or the refund prior to filing, and get this legally documented. But before you do filing married jointly, I do want to mention about the law of joint and several tax liability. If you do file a joint return, this means both you and your spouse are responsible to pay the tax, penalties, or interest due with the return. Okay, so that means if one spouse doesn't pay the tax, you may have to. Again, this is another reason to be sure you've got good representation and legal documents stating who's responsible for what. I do want to mention also, if the divorce is not amicable, CPAs are not working together, there's no representation, it's basically first come, first serve. So it's the end of the tax year, you're both married, but if one spouse decides like January 1st to go ahead and file married filing separately, the IRS is going to accept that method. So if that spouse files and claims all the children, the second spouse that files is not going to be able to claim the children. If they do, it's going to be rejected. Also, if that first spouse itemizes because it's more beneficial for them, the second spouse that files is going to have to itemize as opposed to taking the standard deduction, even if that results in negative tax consequences. So hopefully this won't be the case, but I did want you to be aware. So this is another reason it's really beneficial to work closely together. Now, at the end of the year, if you're legally separated or divorced, you must file either single, or you can file head of household or remarried if you're married at the end of the year. So basically, whatever your status is as of 12/31 is how the IRS is going to require you to file. Okay, so I did mention head of household status. This comes into play when there's any children in the marriage. So claiming the children is going to be looking at when you're going into mediation or filing for a divorce, because it does come into play really in two different areas for tax purposes. The first one that I mentioned is head of household status. In 2024, the standard deduction for head of household is at $21,900, as opposed to if you were single, a standard deduction of $14,600. So how do you qualify for head of household? You must file an individual tax return, so you can't be married. You must claim you cannot be claimed as a dependent on someone else's tax return, and you have to have a qualifying child or dependent. So how do you know if your child is a qualifying child? There's 5 tests. There's a relationship test. So it actually has to be a child, but it can be a stepchild or a foster child. The age comes into play. The child has to be under 19 or 24 if they're a full-time student or they're permanently disabled. Residency, they must live with you in the United States for more than half of the year, and you pay support of more than 1/2 the cost of keeping up your home for the return. For the year. And the joint return, the dependent cannot file a joint return. So if that all qualifies for you, being able to claim head of household status can give you an additional $7,300 in deductions. So that's a big consideration for claiming the children. The other one is the child tax credit. The child tax credit in 2024 is $2,000 per child. Now, this is not a refundable credit, meaning it can only reduce your tax liability. But if the taxpayer is not able to use the entire credit, there is an additional child tax credit, which is refundable. But please be aware these credits start to phase out when gross income exceeds $200,000 for single and $400,000 for married. So if one spouse's gross income meets this threshold, And if they are married, example, doesn't qualify for head of household, claiming the children is not going to be beneficial for tax purposes. So during mediation or litigation, you want to understand this tax consequences and when it benefits and the children come into play because it might not help. Um, Also, just note that these are just the top two areas to consider when it comes to children. There's many others such as earned income credit, dependent care credits that can come into play. But I could probably take up this entire webinar going into that. But I do want to give Amy a chance to talk. So Amy, I'm going to pass it over to you to talk a little bit about the legal side.
Thank you, Beth.
Mhm.
Um, as you can see, Beth and Christina have a lot of information, and I know it can seem overwhelming, but that's back to the main point is why you need a team. Because what Beth just spoke on, I'm an attorney. I could help you with your divorce and your estate planning, but I could not help you with any of those deductions she just talked about. And the most important aspect is that you have the team and that all of this is documented. All of us have made a reference to mediation versus litigation. The most important takeaway is having your own representation. Even if you are going through an amicable divorce, just because you have your own attorney, your own CPA, your own financial planner, does not mean you're going to get into a 5-year divorce battle. It just means you have someone on your side making sure all of these elements are addressed and all of these items are in writing. Because your main concern at this stage in the divorce process, whether you just be starting a separation, is, even at the separation stage, you're talking about things like child support, alimony, who's paying what bills, who's getting what piece of property. And people think, well, we agree on all of that. That's great if you agree now, but 6, 8, 3 years from now, if it's not in writing, you may not have protected yourself adequately. And as Beth mentioned, all of those issues, whether it be claiming head of household, claiming the children, how you're filing taxes, the more information and detail you can put in that separation agreement or divorce decree, the better. So that's why it's better to bring all of those people to the table when you're having these conversations. One, to take the pressure off of you to remember all of these aspects, but two, because each professional brings something that the other may not think, in making sure that at the end of the day, when you have that divorce decree, it is as comprehensive as possible and it covers all the issues you need covered. So you can at that point move on from that stage into the next stage. Know too, as you're going to have a divorce attorney. I come from the estate planning aspect, that your divorce attorney is to get you across the finish line of getting that decree. But there may be additional steps, just as Christina talked about the quadro. You may have in your divorce decree that you're getting the retirement account, but until you take those additional steps of getting the quadro and working with your financial planner, working with your estate planning attorney, getting the deed filed to get your spouse off the house or refinance, you're not complete in that divorce journey. You can't 5 years after the fact go sell a house without the ex-spouse's permission if you never went through that next step. So that's another important part of your journey, is that just because the divorce decree is entered, you still need to be working with all of your professionals to make sure all the T's are crossed and the I's are dotted. I think that Sarah now can talk about, we've all discussed protecting your assets and protecting it during the division. Sarah is going to speak to how you can protect it from cyber attacks and your individual information.
Amy, do you mind if I join in 1 second of something
No.
that you mentioned prior to going into Sarah? You did mention alimony, and I failed to mention this during my tax segment. Alimony used to be tax deductible for the spouse paying and considered taxable income for the spouse receiving the alimony. Now, this changed with the Tax Cut and Jobs Act, and so anything payments after January 1st, 2019, alimony is not included, is not deductible or included as income. So that might come into play when you're getting alimony. Also wanted to note that child support is not eligible as a deduction, nor is it taxable to the receiving spouse. So I just wanted to throw that in there since you mentioned it. All right, thank you, Sarah.
Yeah, no, thank you all for sharing this, and thanks, Amy, for setting me up. This conversation is really about mitigating risk. And Christina, Beth, and Amy have all talked about ways you can mitigate risk and really protect your assets. And one component of that would be just incredible to consider, really important to consider, is protecting your information and your digital assets. So, in preparing for our discussion with V, she just shared the importance of obtaining a new email address, something as simple as a new email address, changing your passwords and changing your PIN numbers to restrict and limit access to your financial and personal accounts. So, really simple, just changing how you access those accounts and making sure nobody has access that you don't want to have access now. Um, Additionally, where it's possible and where it's advisable by your legal team, you may also consider closing jointly owned credit cards and bank accounts as well. And certainly sign up for credit monitoring or freeze your credit to further protect your financial situation. And another component of this is actually securing your physical documents. And even though many bills and documents are sent electronically these days, if you do plan to move after your divorce and therefore change your address, set up a P.O. box in the meantime so you don't miss any important paperwork, but then always remember to forward your mail to the new address after you've moved. So we have shared, I'm putting my moderator hat back on, by the way. We've shared so many different insights and details and, just things to consider as you work through this. And you can see there's a lot of complexity in navigating divorce, and everybody's situation is very different. But it is important that you consider these details to position yourself well for the future. And while we don't expect this to be a fully comprehensive conversation, and we don't recommend using this as a guide to navigate your divorce, we do want to just use this opportunity to illuminate some areas for you to consider, as well as demonstrate the value of working with professionals who can objectively help you work through the details. So thank you, Amy, for really driving that point home. So at this point, I'd like to shift gears. We've been speaking to the people who are, maybe just now beginning the process of separation or kind of considering divorce and what first steps should be taken there. So let's shift gears now and speak to those whose divorce has already been completed and they're really interested in planning for the future and building wealth and protecting their assets in the process. So I'm going to put my V hat back on and I'm going to talk about how critical it is to protect yourself from scam and fraud attempts because that's a huge component of mitigating risk. So planning for the future also presents the opportunity for a future romantic relationship. And we've been talking a lot about logistics and paperwork and division of assets today, but your emotional and romantic life also presents risks that you can address. Unfortunately, single individuals and especially single women are a huge target for romance scams and other fraud attempts. And so, as we prepared for the discussion today, V talked about the variety of different scam attempts that fraudsters can execute. But a common theme that I really would like you all to take away is that each scam is using some form of emotional manipulation for the sake of getting to your finances to create a financial impact. So I'll say that again, fraudsters are using emotional manipulation as a way to get to your finances. And online romance scams are one example of this emotional manipulation at play. Fraudsters sometimes target single individuals' social media or dating app profiles, and they work over long stretches of time to develop trust and to create an emotional bond with the potential victim. And they might start asking for small amounts of money to start out to kind of test the waters and see if this person's willing to bite, so to speak. And this is all with the intention of gaining access to more money in the future. So it's incredibly important not to share financial information or to share funds with people that you've not thoroughly vetted and you don't know very well. So even when meeting a person by phone or video, you can't always have confidence that they are who they say they are because AI has advanced drastically over the past few years and will continue to advance. So now is as good a time as ever to encourage you to stay aware and be cautious. Other scam attempts might not always appeal to romantic interests, but to financial interests, perhaps, for the victim. So there are different investment scams that might claim to provide high returns with little to no risk. But I'll let you on a little secret. If you spent any time with a member of our financial advising team, you know we are always quick to say that risk and return are inseparable. So that's a huge red flag if someone offers a ton of gain through an investment with no risk. There are also investment training scams, business scams, and real estate scams to be wary of. So just continue to stay on your guard as you chart this course. scams can also be more acute or happen in a shorter period of time. You might have heard of fraudsters calling elderly individuals claiming that their grandchild was in an accident or they're incarcerated and they need money. And this scam, again, is playing to the emotions. It's designed to cause panic and make you take action before you've had a chance to think about it. So the rule of thumb is to slow down and think before you send money to anyone, and to always avoid sharing financial information with somebody you don't know. If you have fallen victim to a scam, though, don't be ashamed, because these scams are literally engineered to play to your emotions and to take advantage of those emotions. And ultimately, again, the goal is to access your finances. It doesn't matter how well your financial plan is working if somebody's gotten access to your bank account and pulls all your money out. So, if you have been a victim, it's important to get in touch with law enforcement and file a complaint with the FBI so that fraudsters can get caught and others don't get victimized. So, I'll shift over to Beth, because one component of considering a new romantic relationship, like I talked about, I doubt anybody's really thinking about their new partner's tax history. So, Beth, I'm going to turn it over to you just to share a little bit about what should be considered as far as taxes go and
Yeah,
considering a new
thank
romantic
you.
relationship.
Thank you so much, Sarah. That was very interesting. Um, Sarah's correct. If you're divorced, and hopefully you're getting married a second time. Who knows if you want to or not? But please, when you marry this person, we need to know their background. If they had tax debt before you got married, wanted to let you know that they are only the one that's responsible for that debt. Okay, you're not liable, so don't worry about that. What you do need to be worried about and need to know is if they don't tell you that they have this tax debt, you are married and you're filing a joint tax return, and I'm saying, oh, guess what, Christina, you're getting a $10,000 refund, and you're all excited and planning what you're going to do with it. All comes to find out that you get a notice from the IRS that it has been intercepted to pay off all or part of your new spouse's debt. That is a possibility. I've had this happen many a times, and this is the first time the spouse has found out about the tax debt of the new partner. So this is an area, where you really want to know, and not have the shock factor, and plan to spend that refund when you might not get it. So I don't know, Christina, if you have any questions or concerns about finances when it comes to new spouses.
Absolutely.
Well,
We certainly do. I Before we get to me and kind of talk a little bit about that on the planning side with this, we'd love to hear from Amy on some of that safeguarding and steps that you need to take from an estate planning standpoint. That would be, I think, super helpful.
yeah.
And then I'll kind of talk about the financial planning piece.
Okay, thanks, Christina. Yes, so now this is regardless of whether that next relationship has started. You are now divorced. And all of your presumptions that you had as a married person, that you own things jointly, would automatically pass to your spouse. People always presume that, okay, if I don't do anything, it just goes to my kids. And Christina had made this reference earlier about the guardianship issues. So your overview is you need to take a look at how your assets are titled now after, and make sure all those beneficiary designations are up to date. And if you do have minor children, there's special considerations for that, because you don't want them to inherit directly. Now, that does not mean that you list your sister in order to receive all the assets, because your sister's going to take care of your kids. That's a terrible assumption. And that's one of the most common mistakes we have, is that people say, I know grandma and grandpa will take care of my little one, so I'm just going to list them instead of having to go meet with an attorney. Um, there is very simple planning you can do to make sure that if God forbid something happened to you, or you were unable to care for your kids, that money can be used for them. It will only be used for them, and it can be stretched for their use through the time where they can take care of themselves. So as Christina's going to walk you through, is becoming financially independent, you want to protect that independence so that it benefits the people that you want it to benefit. You also need to think about the fact that now that you don't have a spouse, who would make decisions if you're in a car accident and you need someone to make healthcare decisions for you? Who would make sure your bills get paid and have access to your bank accounts to continue to care for your kids if you're unable to do that? And there's a difference between if you're just sick and in the hospital versus you're deceased. And that's a whole plan that an estate planning attorney can walk you through. The other thing, like Christina had mentioned, review all your beneficiary designations. As an example, just had a client that passed away who's been divorced over 20 years. And 6 months before his death, they discovered a $50,000 insurance policy that was going to the ex-spouse. No one would have wanted that. So make sure all of those are up to date now that you've passed, but make sure it's done correctly so that it does get to your intended beneficiaries. And so then in the next step is you do find that new relationship. And now you're talking about joining with someone else. Well, just because you're joining your lives doesn't mean you need to join your assets. I like to refer to prenups as more of an insurance policy than something saying the marriage isn't going to last. But based on your previous experience, almost having that in place takes away that pressure. You have what was yours, he has what was his, and those things remain separate. You can still have joint assets, but it's very important in Florida. If there is no prenup, there are certain rights that a spouse gets regardless of what your estate planning documents say, regardless of what your beneficiaries say. A new spouse is entitled to 30% of your estate if you are the one that passes first, whether you have children or not. They are entitled to the home, even if it's a home you brought into the marriage, even if it's a home that you're the only one on the deed, even if it's a home that you paid the entire mortgage, they are entitled to half of the house. So those are important things that you can do a prenup, based entirely on waiving those kind of rights. It doesn't mean you can't provide for that person. It doesn't mean you can't live a long, happy marriage. It just means that for the things that you're both bringing in, they remain separate. And that goes for both assets and liabilities. If they are coming in with the debt that Beth mentioned, that's on the prenup as their separate debt, not something that you can be saddled with should something happen to them. And real quickly on the guardianship that was referenced, if a child under Florida inherits more than $12,000 and they're a minor under the age of 18, and there is no estate planning and or trust set up for that child, whoever you have appointed or whoever is selected by the court to be their parent has to get appointed as their guardian. From the time you die until that child reaches 18, every year that guardian has to go to court to ask for money, submit accountings, submit plans from their doctors, all till they're 18. And then at 18, whatever is their share, they get outright, which, as most of you know, there's not many 18-year-olds that are mature enough to inherit a large sum of money. So again, there's very simple planning that we can work with you on to make sure that that money stays in trust. It will still pay for their health, education, support, and maintenance. They will have access it for their needs, but they're not going to go backpack for a year in Europe because they just inherited, $2 million. So those are things that now, your overarching view is you have to look at it from a new perspective. You are no longer a husband and wife. You are the mother, and you need to look out for what's best for you and your children going further, even if that new person comes in. And I think Christina is going to talk to you about setting yourself up financially for that independence.
Yeah, thanks, Amy. So kind of tagging on to what Amy has said and Beth, women typically have a shorter work history. They typically make less money, live longer than our male counterparts. And we also tend to be more conservative investors. As a result, ensuring you receive your share of the marriage assets and that you protect, Amy has spoken greatly on that, you preserve and you grow those assets, it's absolutely critical. It's also imperative that you make informed decisions along the way as you work on your new financial reality. So I want to speak to one thing that we hear all the time when we're working with women, whether it's through a divorce or maybe loss of a loved one. We have this urge, and it's very common, to want to pay off debt, a mortgage, a car payment, whatever the case may be. Resist the urge. you need to know your financial plan first, and taking liquid assets to simply pay off debt may not serve you well in the long run. You really need to have the plan set first. Also, you've got to resist the common mistake, and it's already been referenced, but I'm going to repeat this. You've got to resist that common mistake of adding adult children, relatives, or romantic interests on your bank and investment accounts. And ladies, if that romantic interest evolves into something more, as Amy said, get the prenup. Remember that the goal is to protect you, your assets, and your step up in cost basis. Music to Beth's ears. You want to protect that step up, and your children are going to thank you and remember you fondly as being a very wise and very savvy woman. So just make sure that you're slowing down and you're making good decisions. I also want to speak to the fact that there are special rules that apply to Social Security and military pensions and health benefits. So if you were married for 10 years or longer, it's important to do your research, as this can have a very significant impact on your retirement plan going forward. And again, a planner is going to be able to help you navigate these aspects of your new plan. So after divorce, it's critical to reset expectations. You've got to update your financial plan based on that new stage of life. You're navigating a new financial reality that can be incredibly daunting, but you don't, as we've said, you don't need to do it alone. You're going to gain clarity on frequently asked questions such as how long will you need to work, how much do you need to save, and how much risk do you need to take, right? Or should take? Because again, women do have a tendency to be overly conservative. And sometimes you've got to push, especially a little bit more while you're younger, and take a little bit more risk to ensure that you're going to have enough assets to take you to and through life expectancy. So working with that financial planner and an entire team to assist you in visually mapping out your financial plan can provide some much needed peace of mind. Also, I think it's really important because, again, I'll reference back to where I started, that women in particular have a tendency to not feel as comfortable being engaged in the planning process. But participating in regular check-ins to ensure that you're staying motivated and on track to achieving your newly reset goals, it too is going to help you with that peace of mind. So, Sarah, I'm going to turn it over to you to kind of help us with the wrap up.
Sure. Well, thank you all for these insights. And for our attendees, as you've heard, there are just a huge number of important details that need to be considered where you're working through divorce and then also planning for your future from financial planning perspective, estate planning perspective, and tax planning, as well as mitigating those cybersecurity and fraud risks. There are many things that need to be taken into consideration. And in the moment, and when you're in the middle of a divorce or you're working through these details, you might feel like all of this is just weighing on your shoulders. But we really strongly encourage you to build a team of professionals who can help you make decisions solely in your best interest by separating the emotions that you might feel from the business decisions that you need to make to serve you. So look for advisors who will tell you the truth rather than just comforting you. Look for somebody who will tell you the truth and who will serve your best interest. Ultimately, your advisors will help you achieve peace of mind, knowing that your assets and your wishes and your children are protected as you move forward into your new chapter. So, to close, we on the panel would love to hear from you if we can be of assistance as you navigate divorce or separation and chart a path forward. And thank you very much to our audience for attending today. Like I mentioned before, you will be receiving a survey after the event concludes. So please complete it and share your feedback with us. And if you have any lingering questions, please do share them using the survey, and we'll be sure to capture the questions and get them to the right expert for a response. And if this has been valuable to you, we ask that you share the recording with a friend or a loved one who might find benefit from it. We would be thrilled to help them individually as well. So please reach out if we can be of assistance to them. We hope you'll keep in touch with us and stay on the lookout for future Building Confidence series conversations and events. And thanks again to our fantastic experts for sharing these insights with us today. This concludes our time together. Please be sure to let us know how any of us on the panel can support your needs. And thank you very much for attending.
Thank you.